if you do have any comments, or if there's anything in particular you'd like us to cover in these webinars, we're always happy for you to send us through an email or get in touch, because we want to make sure we're presenting information that's relevant for you guys each week. But having said that, we'll jump into today's agenda. So, like the last several webinars, we'll of course cover a market update, see what's happened over the last week and what's happening in the economy generally. Then we'll do something which is a bit different from what we've done the last week or two. We'll look at the last couple of downturns over, or the last major downturns over the last, say, 30 years, and see what lessons they really had to teach us about what to expect from future downturns, and yeah, discuss the key messages that have come out of those. And as Gil said, he'll jump back on at the end just to give you a few of his thoughts, particularly around what's happening with oil at the moment. You might have noticed, if you've been following the news, there's been a fairly large fall in oil prices of late. So that'll be an interesting few points there. Before I jump into today's agenda, though, there are a few areas we won't be covering that we touched on in a fair bit of detail in our last several webinars. I'll just quickly summarize those and let you know, or just remind you, that all our webinars are available on request. If you get in touch, if you send us through an email and want to review any of these points, we can always send you through one of the previous week's webinars. So, over the last couple of weeks, we've covered in a fair bit of detail the government stimulus packages that have been released, the ability to reduce account-based pension income, the various additional payments that are on offer for pensioners and allowees, JobKeeper, Job Seeker provisions, and also early access to super. We'd also covered, in a bit more detail than we're going to today, some global economic indicators, such as a few Chinese measures which show that the Chinese economy is starting to warm up again. They're sort of they're a bit further ahead of everyone else, and they're starting to ramp up a little bit in terms of their economic activity. And also the London Interbank Overnight Rate, which is a measure of global banking confidence, looks fairly positive as well. So Gil covered that in a fair bit of detail in the past two presentations. Gil also covered the Reserve Bank's economic outlook that was released this time last week. It showed, basically as a summary, it showed that yes, there is expected to be a fairly sharp downturn, and there has been a fairly sharp downturn in economic activity, but also it flags hopefully a fairly healthy economy in 2020, fairly healthy recovery in the economy from 2021 onwards. And also, I liked Gil's takes at the end of last week's session. He went through a fair few areas of the economy and what his personal opinions are of those different areas. Covered everything from property, car prices, holidays. So I thought I'd just mention that one's there in case you want to revisit that one. All right, so just some housekeeping before we get into the market wrap. The session should last 15 to 30 minutes. That's our target. I don't think we've had any that have been under 30 minutes, but we'll see how we go. Please ask questions via the chat icon. Your microphone has been muted, so if you do have any questions, just go to that little chat icon here at the bottom of your screen, type them in, and we'll have a review of them at the end and try to cover off on any major topics that arise in those questions. If you have any difficulty with the sound, try turning your video off. Sometimes if the internet, if your data level is under a bit of pressure, turning the video off will at least allow a good deal of sound to stabilize. As I mentioned in the last slide, this session is recorded like all of them, and we can make it available on request if you want to revisit any of the information. And of course, we can never get stuck in without the disclaimer. We want to provide relevant information that you're going to be interested in, but it is general information. It's not designed with anyone's particular circumstances in mind. So if you do ever want to know specifically what these economic factors mean for you specifically, don't hesitate to get in contact with us and we can run through that with you. Okay, so without any further ado, we'll just kick off with the market update. So the past week, what's happened over the past week? Markets are still very volatile, as you've probably noticed. 2 to 3% increases and decreases are not uncommon. They would have been unheard of, say, you know, any other period a year or two ago, but it's the norm on a daily basis now. We're down about 5.48% over the past week. So we have seen some fairly strong gains over the past month, but it's just cooled off over the last week, and we'll cover off on a few reasons why that is. Virus cases seem to be easing significantly globally, which seems like it's, which is of course great news. And governments are starting to consider easing restrictions, some more than others. Some are talking about getting back to some level of economic activity and easing restrictions as early as the next couple of weeks. Some are suggesting a bit longer. Our government has flagged it, but hasn't given us any specifics. What we are getting, though, from the medical experts is a caution that, yes, we might want to get back to work and get back to spending and get back to some degree of normalcy, but we've got to be really cautious. We've done a lot of great work with our social distancing, but there is a real danger of a relapse if we're a bit too enthusiastic getting back to normal too early, and that would of course have really bad economic consequences. So there's a bit of uncertainty that's crept up over the past week as the discussion has gone from let's social distance, this is exactly how you do it, it's getting under control, all very positive, all very clear, and the market responded really well to that. At the moment now, we're in this little balancing act where things are about to shift. We're going to start to see a change in what the government's asking of us. And it's yet to be seen whether or not it's going to cause issues with a relapse in the virus. The government's been pretty clear on what it's expected of us so far. So when it does start easing restrictions, we'd expect them to be fairly direct with that. So hopefully then the market will respond well and continue its rise. But at the moment, in this uncertain period, we are seeing a bit of weakness over the past week. Oil prices have also contributed a lot to that. We've seen, and Gil will cover off on what's going on there in the oil market, but that of course has had a flow-on effect to the results over the last week as well in our market. Patience is key still. We think long-term, as you probably, if you've been following our webinar series, we're fairly optimistic for a strong recovery and a fairly quick one over the next year or two. But patience is key. As we won't just see a continual increase. There will be these periods as uncertainty creeps in or different things pop up on the news cycle, which will cause weeks where we will see a bit of a downturn as we've seen this week. So the Aussie share market, as an overview of what's happened over the past sort of 6 to 12 months, the Aussie share market has actually recovered quite well from its low point about this time last month. We're up about 18.6% from the bottom. We're still down about 27% from the highs that we saw before this pandemic sort of really kicked in. As Gil mentioned in previous weeks, we were really expecting some kind of slowdown over the next year or two anyway. We were at all-time highs and that wasn't going to continue forever. We're probably about 10 to 12% though off the level we kind of thought we would get to anyway once that slowdown occurred. The pandemic of course just escalated the whole drop. For the 12 months though, we're down about 18.23% in total. And part of the reason it's not down more is we had that fantastic first 6 months of the financial year. The US market, it's recovered a bit better. The US market tends to rebound quite strongly once things start to recover and there's a bit more stability. It's only down 18.7%, 18.69 from its peak. And it's only actually down 6.14% from 12 months ago. So it's just something we see out of the US market. It's a bit more resilient and willing to see rises earlier than the Australian market, which is a bit more conservative in its movements. Okay. So we always like to have a look at this each week as well, just to see the shape of the curve, the shape of infections week in, week out. We hear a lot about it on the news. As it's really encouraging. We're seeing Australia continue to flatten, or at least the flattening started about a lot earlier than a lot of other countries around the world. As you can see there, we did a really good job of social distancing early and really getting behind that, and it flattened our curve quite quickly around this period, well before most other countries, other than say China. But of course, we all have to be careful about the specific data that comes out of China. It's fairly unlikely that's as flat as it's showing there, but a lot of other countries that haven't quite implemented social distancing as well as us are only just starting to see their curve flatten. Some that have the US is just starting. You're just starting to see an effect there in the US, and hopefully that'll continue to flatten out. But Australia flattened out quite a couple of weeks ago, and we haven't seen a kick up since then. So all very positive in terms of our infection rate. And as Gil mentioned last week, our leadership, the way it's handled the virus, there's always things that we can pick on, always things that could have been done better. But we've really been put in a position as one of the better countries to be in the world through this period. Just having a look at the graphs that we look at each week, just so we can get a feel for the shape of the markets and what has been happening. Over the last week, we've seen that 5% drop. Oil sort of exacerbated that a few days ago, and we're probably going to see another down day today as oil reaches new lows, and that flows through the US and the Australian markets. But over the past week, we did hear that uncertainty did start to creep in about what the next step is in managing the virus and what that could mean for the economy. And we have seen that ease off over the past week there. Over the month though, still very positive. We recovered quite strongly since March 23rd. And so the downturns we've seen at the moment hasn't been enough to wipe out all that positivity. It's just one of these sort of slowdown periods. And the story since December 2018, of course, we see that fairly strong recovery. The market's quite keen to, once we start to get some good news and it looks like there is some stability, the market is quite keen to push forward. So hopefully once we get a bit more clearer news from the government regarding the next stage, hopefully we'll see that trend continue. All right, well, look, just to change pace a little bit, what we'll do now is have a look at the last 5 major downturns we've seen over the past 30 years and look at what lessons that they've had for us and the key messages. Gil did this a little bit a few weeks ago if you've been following our webinar series focusing on the Great Depression. That's what we'll do now as well, but we'll just do it for 5 different downturns and just cover them a bit quicker. So Black Monday 1987, for those who remember, was a pretty dicey time on the market. We saw very strong market growth in the late 80s. It couldn't last forever, as they never can. Rising Middle East tensions caused that market run to really stop. We saw oil prices absolutely skyrocket in that period, and when things stopped, it stopped very quickly. We saw a 20% drop in one day in the market, which was unprecedented and obviously very scary at that time. It was very untrodden ground. The main reason that that happened, and it happened so badly in 1987, was computers were fairly new and they were starting to be adopted in the trading world, and traders had started to implement trading strategies where their computers would sell their investments automatically once it hit a certain level, and that just caused a very fast downward spiral in the share market, very, very fast, 20% in one day, which had never been seen before. Of course, we've seen it a few times since then. It happened in the global financial crisis, and it's definitely happened, as Gil has mentioned in previous webinars, it's definitely been a factor in how quickly things have dropped this time as well, as large institutions and their computer trading programs really made the drop a lot steeper than what it probably deserved to be from an economic standpoint. So auto trading strategies plus the speed that information circulates through the world these days really means much steeper drops when they happen. The good news is though that the steepness of that drop isn't necessarily backed by economic factors. You know, things aren't as bad as they look when the market drops as bad as it does, because it's artificially enhanced by those trading strategies. Once things start to get better though, it also means we get strong rebounds as those same computer systems start to buy back in again. So we're really hoping to see that out of the recovery from the coronavirus pandemic as well, once things start to really stabilize and we can really see light at the end of the tunnel of this current downturn. The next major downturn was the Gulf War period. So the economy was already slowing. The war caused the oil price to skyrocket. So in that last slide, I meant to say that interest rates skyrocketed, and that was a major factor behind the 1987 downturn. It was the Gulf War where we really saw huge disruption to the oil markets and oil prices really skyrocketed. That caused a lot of tension in Western markets and caused that next bear market, that real bad drop. The war was short-lived though, and markets recovered pretty well, which actually does teach us something about markets that have responded to specific world events, like we're seeing at the moment with the coronavirus pandemic. So world events will always have the potential to cause slowdowns and bad falls in our markets. But markets are resilient and they tend to rebound strongly once a way forward becomes clear. Happened in the Gulf War, it happened in a few other situations we've seen since then, things like US fiscal cliffs, Greek debt crisis. Once we see that light at the end of the tunnel, we don't even have to have the problem solved. As long as there's a way forward and everyone has confidence there's a way forward, we tend to see strong market recovery, which we've started to see out of the current recovery from the coronavirus. The next major downturn was the dot-com bubble in 01 and 02. So there was, if you remember back in those days, computers were all very new and it just exploded. There was, computers were starting to become much more mainstream. Everyone with a desktop computer could start an internet company. And it caused a really big, really quick rise in the markets in the late 90s and early 2000s. It was a self-feeding increase. Everyone had what we call FOMO, or a fear of missing out. They felt that if they weren't buying IT shares, they were going to be left permanently behind in terms of their investment portfolio. So a lot of people jumped in and bought anything IT. It didn't really matter if the companies made sense, if they were making money, if they had a solid business strategy. Didn't really matter. Everyone just wanted to jump on that trend. Although in 2000 it became obvious a lot of those business models weren't really viable. They were never going to make money. And of course, we saw a very, very sharp downturn, particularly in America and maybe not so much Australia, but the impact in America did have some flow-on effects through the early 2000s in our market as well. The lesson, of course, is that the fear of missing out can definitely be overwhelming, but history has shown time and time again that chasing the shiny new trend is often dangerous. No matter how much it sounds like it's the thing to do in the news at the time, no matter how much enthusiasm there is, you've got to focus on the fundamentals. And if the fundamentals aren't there, then don't go chasing the shiny new toy. Global financial crisis, of course, still quite fresh in everyone's mind. Background there, of course, was from that dot-com bubble, from the end of that period in about 2003 through to 2007, we saw huge market gains, very, very large market gains, very, very rapid over those years. And investors started to lose focus as that increase went on. People got overconfident. They didn't really feel like things were ever going to go down, especially property. People thought property would never reduce. And they started to ignore the risks that underlay a lot of the investments that they were taking on. And then, of course, in 2007, all those problems got blown wide open, causing the sharp downturn we saw in the global financial crisis. Now, that crisis wasn't easy to fix. It actually was caused by fairly significant and real economic factors that were only going to be unwound and fixed with fairly significant global government intervention. The key lessons from that downturn was strong markets will never last forever. You don't necessarily know which year they're going to fall, but they won't last forever. Portfolios must be set up with downturns in mind. So we know that a bad year's coming. It's not if, it's when. So it's important to structure your portfolio to wait out those bad periods. And again, traditional financial basics, the fundamentals, again, should never be ignored. So that brings us to a few key messages that arise out of those major downturns that we have for has implications for how we manage your money and your portfolios as advisors. So downturns are inevitable. Patience is absolutely key. History shows that markets really reward patient people who don't overreact to market downturns, and it really harms people that try to time the market, that try to jump in and out when markets are going up and down. You might remember this graph from reviews. We often cover it in our reviews with our clients. What it shows is that if you had $10,000 and invested it in the Australian market and just left it from 2004 through to just before the current downturn, and just left it alone, ignored it through all the ups and downs, ignored the global financial crisis, the fiscal cliffs, the Greek debt crisis. Up until last year, that $10,000 will have turned into about $40,000 even through all those bad times. Yet it also shows that if you try to time the market and jump in and out, and try to pretend like there's that crystal ball available where you'll be able to really time that market well, if you miss out on the 40 best days out of those 5,000 odd days, your portfolio would only be worth 9,000, less than what it started with. So really demonstrates that patience is key, and that, you know, these downturns happen. They're a normal part of markets long term, and that markets really reward patient investors. Another factor that we need to focus on that we covered off in those downturns was that market recovery can often be quite swift, especially when the causes were clear, like the Gulf War, like the current pandemic, and some of those other crises there, and once solutions are identified. So we would really expect that. We started to see that here in the current coronavirus pandemic. Markets definitely improved as social distancing measures started to work and appeared effective at stopping the spread. And as long as over the next few months, the measures that are released by the government continue to control the virus and keep that curve flat, we would expect the strong recovery to continue. Those periods also showed us that government intervention is crucial when there really is legitimate underlying economic reasons for the downturn. The Great Depression, the global financial crisis, absolutely driven by economics. Same as the coronavirus. This isn't just a panic with no basis. We are seeing a really strong slowdown in economic activity because it's been forced on us. The government is making everyone stay home. We're not out there spending at movies. We're not out there at restaurants or taking holidays. So yes, there is absolutely a slowdown in government activity. But history has shown us that won't necessarily cause a long-term problem for the share market as long as the government takes steps to counter that impact. And what we're seeing from our government is they've come in hard, they've come in early, they've released unprecedented levels of stimulus, and they've made it clear that they will continue to do so. They're committed to doing whatever needs to be done to stimulate the economy and make sure that the recovery is strong out the other side. So that gives us a lot of confidence that our government is doing what it needs to do in response to this very real economic issue. And we would expect that that should really aid the recovery long term. Focus on quality is always key when investing. We want to avoid that fear of missing out, as we saw there, dot-com bubble, complex products like what we saw in the global financial crisis, the resource boom, and Bitcoin was probably the most recent one. When these things arise, and we might see them going forward as well, we really want to make sure we're not over allocating or moving our portfolio to jump on those trends. We want investments with good, solid fundamentals, and be wary of anything with too much of a focus on getting to the top of performance tables or showing abnormally high returns. We've just started to see, and you might remember from last week's webinar, I believe Gil touched on this a little bit, the industry funds who have been very keen over time to get to the top of the performance tables that are released each year by the media have taken fairly large levels of risk with how they've positioned their portfolios. They've invested in things that are quite illiquid, and that's starting to cause them problems. So again, we don't want to sort of chase too high returns if it means that the risk we're taking is too high. We want good common sense portfolios for good, stable, long-term returns. And of course, diversification, lots of eggs, lots of baskets. Always has been a good idea and always will be. Portfolio tailoring is crucial. It gives your portfolio time for recovery. So what you will have seen in your reviews, and we touch on this just about every time we meet up, is we want to make sure that we've got good portions of your portfolios in defensive assets to meet your needs over the next couple of years, so that when we do see a drop in share markets like we're having now, we've got your needs covered for quite a while to come. So we've left ourselves plenty of time for the recovery to take effect and for the share portfolio to come back. And of course, reviewing and adjusting that each year, as Gil touched on last webinar, we're very vigilant to make sure we're adjusting your asset allocation as we go each year in the good times, so that when the bad times come, you're well established, you're well set up. This is an interesting slide that we've had a bit of feedback that this is received quite well. This shows your standard kind of balanced portfolio, about 60 to 70% worth of growth and about 40% defensive, fairly common for a lot of our clients. Even during this current downturn, because of the way we've positioned the portfolio, because of the asset allocation, and because of the quality of the underlying investments, we've actually only seen a negative 1.68% drop in this portfolio year to date. So we had very strong returns in the first part of the year, which has really helped to buffer and dampen the effects that this current pandemic has had on this portfolio. And it's something we're seeing very commonly, where we're seeing low single figure negative returns in a lot of our portfolios. And that really does come down to a large extent to being disciplined with our rebalances and our asset allocation as we meet with you each year. So I hope all that has made sense. I'll throw back to Gil now, because Gil will always like to have a chat at the end, and he would like to cover off on the current drop in oil prices in a bit more detail. Gil, did you want to take control of?
Certainly, Ryan. Can just everyone put their hand up? Can you hear me okay? Excellent. Thank you very much. So well covered, Ryan. To an extent, ladies and gentlemen, obviously we're in a waiting game at the moment with the way markets are, but Ryan, I'll get you to just cycle through the slides because you've got control of them. So we can go to the next slide, please. Sorry, guys. That's very bad webinar etiquette. So yesterday we saw, if you listen to Channel 9, which I like to do because it's sort of like the comedy news network, we saw the first time in history that oil prices have fallen below zero. They actually went to minus $35 a barrel, if you believe Carl Stefanovic. Now, what actually happened was that the world has so much oil that they don't know what to do with it at the moment. And as a result, the futures contract, which is the promise to buy a barrel of oil tomorrow or next week or next month, we reached a point where nobody wanted to buy tomorrow's oil. Now, that ultimately, Ryan, if we can go to the next slide, is a problem associated with storage. If you look, you know, and this is a little bit hard to get this information, but the world consumes roughly 100 million barrels of oil a day. Now, I don't know what a barrel is, but it turns out it's about 160 litres, so it's pretty close to a 44-gallon drum. Demand in the growing Western economy, or the growing modern economy, tends to go up at about 2.5 million barrels per day per year. The demand in April 2020 is roughly 30% lower than it was this time last year, 29 million barrels left. Now, in response to that, the Arabs and the Russians have decided to reduce oil production by 10 million or 9 million barrels a day, even though we're consuming 30 million barrels a day less. We are literally running out of space, right? Now, the Arabs and the Russians have no choice but to reduce the amount of oil they're producing. This is one circumstance where the Americans are actually a bit more flexible, because once you stick a hole in the ground, the amount of oil coming out of it is hard to stop in Saudi Arabia or Russia. But it turns out when you're fracking oil, which is why the Americans do it, it's actually quite easy to stop pumping gas down there to push the oil up. So just to be really clear, the oil price did not hit minus $35 yesterday. The promise to buy a barrel of oil in 6 weeks or 6 months' time went negative. The average consumed price of oil at the moment is still somewhere between $10 and $22 a barrel, depending on whether you're talking about American oil or whether you're talking about Singapore oil and whatnot. So Ryan, if we can just go to the next point. You will remember from years ago the warnings that we were going to run out of oil. Never a falser word has ever been spoken. We never ran out of oil. We're not even close. There are thousands of years of oil left in the ground. What they meant was the easy oil was a little bit hard to, you know, was running under pressure. But the US production of oil is based on fracking, which largely means pushing gas and water into the oil table to push the oil up out of the ground. So this is, if you will, low pressure oil or LTO oil. It's got to be forced out of the ground, and for that reason, it's actually more expensive than Saudi oil. And we covered that last week or the week before, where it costs about $40 a barrel for the American companies to produce it. Now, there's the third point there, or fourth point there, is the most important one here. The way the American economy is structured, the oil companies rely heavily on debt to fund their expansion and growth opportunities. So there is a lot of what they call bond or paper in the US market associated with money that the oil companies owe the stock market, if you will. Now, in and of itself, if those companies aren't making a profit, it's hard for them to repay their debt. The government's done their bit by printing money and getting interest rates down as low as possible. But a lot of the activity that you don't really see on the media happens here, where the governments use the money they're printing to go and to buy the debt of some of the corporate entities up, as well as some of the local government entities and state governments. And by doing that, they're injecting money into the market because someone is selling them that bond or that debt instrument. And as a result, the cash is freed up and is used for other things. However, and this is important, do watch the oil price with some attention here, because this actually does present a risk for the American market. And this is why the market, I think, has been going down the last few days, because the considered view is that the Arabs and the Russians still haven't finished producing too much oil. The world is simply not burning anywhere near as much as they used to, and consequently the current production levels are basically pushing the price of oil lower and lower. Now, I don't know that the Arabs and the Russians are being overly friendly to US oil interests at the moment, but what I do believe is that the government in the UK and in Europe and in USA and Australia, they need the oil revenues. This is one of the reasons, by the way, that I don't know that electric cars are ever going to take over the world, because the government can't tax the electricity like they can tax petrol. So if you ever want to look at anything interesting, take a look at some CSIRO publications on the production of ammonia as a liquid fuel. They have a very inspiring picture of how we're going to be able to take water, nitrogen, and electricity and use it to produce ammonia and oxygen, and then you burn that in your normal car, and it produces it produces water, nitrogen, and heat. So I actually think there's a very large chance that we won't see electric cars in future. We're going to see hydrogen-powered cars or ammonia-powered cars. Anyway, back to the point about the oil revenues. If we see continued sustained low oil prices, that does become an issue for the American market. 12% of their bond market is associated with the petroleum industry. Go back one, Ryan, you leave it where it is. We will also, though, as a result of that, if it does stay low, we're going to see a pressure down on the Aussie dollar. Now, for some of those portfolios that we've been going through with clients, any share market-based funds that are linked to the Aussie dollar are actually holding themselves up very well, even though the US market might be down 20%. The Aussie dollar is down a healthy 15 or 16% as well. And as a result, this is one of the reasons why some of these portfolios haven't shown excessively negative returns. So watch for the Aussie dollar to go down. It's going to make it cheaper and easier to spend time at home anyway. So the next slide, Ryan, please. Here's an interesting graph which just shows what happened after 9/11. So this is a US graph, but effectively the darker blue is the production of fracked oil. This is where they're injecting pressurized water or gas into the earth, and they're pushing oil up out of it. So fracking, as you can see, has gone from being, in 2009, none of the US energy market, to 2025, they're projecting that it's going to be 50% of the oil that Americans burn. Now, the good news in one sense about fracked oil is that there are, I believe, somewhere in the order of 5,000 years of oil underground. So we're not going to see an energy crisis based around oil anytime soon. Now, that doesn't address any global warming questions. It doesn't address any questions whether we should be using the oil. But what this does is it creates genuine independence from the Western economies being held over a barrel by the Arabs or the Russians. Now, the only risk here is, of course, that the Americans are a bit vulnerable to low oil prices because it costs money to produce that blue oil. So, Ryan. So what does it mean for Aussie prices? Well, the current wholesale cost of petrol in Australia is 82 cents a litre. Sydney prices are 94 cents a litre. Country prices are $1.10, $1.20 a litre. They're seeing some prices down to 76 cents. I have a particular hatred for the petrol companies in this country and the way they manipulate the prices. But I don't know that we're going to see too much pressure from the government on this one because for two reasons. One, they want the oil companies to be profitable. Secondly, when the prices are high, the government taxes on petrol stay higher as well. And the government does want to collect all the money it can. So I don't know that we're going to see much ACCC investigation into the oil prices. But the reality is it's down around $1 to $1.10 for most of us in the Hunter Valley. I found this little graph, which I thought was quite interesting, though, in terms of where most of the petrol is sold in this country. And it would appear that the big oil companies that we're familiar with are only 33% of the market. The rest of it is either the independent companies or Coles and Woolies, which is quite staggering in the amount of volume that goes through Woolworths and Coles. But the other piece, though, is you've got to look at it and realise that 48, 60 7% of the market is not linked to the actual oil companies themselves. They are simply reselling someone else's oil or someone else's petrol. So, Ryan? So without wanting to spend too long, there was a question from Cherie Johnson, which I'll get to, but I'm very much of the opinion here that reacting the way that Channel 9 and Channel 7 want us to, which is fear and uncertainty, is exactly the worst thing to do. If you define a terrorist organisation as one who spreads fear and misinformation so as to modify your behaviour against your will, then I think a media can be held accountable to that. They're trying very hard to keep it under control, but they can't help themselves. I saw Channel 9 this morning talking about the average investor is down 15%. And we just showed you some graphs. It might be true that we're down 15% from the peak 2 months ago, but most people don't look at it in terms of months, they look at it in terms of years. And the average investor is down 5 to somewhere between 0 and 5%. Certainly that's the way our client profiles are looking. Cherie, you asked a question earlier, with so many people wanting to withdraw their super, what effect will this have? Now there's two answers to that question. I'll talk to the industry fund question first, because we're delicately jumping around something there, and the question of industry funds. Over the last few years, the industry funds have benefited massively from the inflow of money from the government contribution to super, the SGC. Now, the industry funds are really, as a general rule, they're not very good. They're not set up to pay pensions. They're set up to take money in. So what they've done is they've hunted around and they've gone and bought investments in properties, in resorts, residential property and whatnot. Now, with the reduction in wages and the reduction in contributions to super that's going on at the moment, in combination with the uptick in withdrawals that's going to be happening, whether it's 20 billion or 40 billion or 50 billion, there are some questions that have been raised in the financial review. We've been loath to publish stuff on this, to be honest, because it feels a bit like rabble rousing, but there's been a lot of articles in the newspapers about whether the industry funds are going to freeze their accounts and actually deny withdrawals for people for a period. And this is ultimately because they put money into assets that can't be sold easily, such as property. Now, that doesn't make them bad investments. It just means that when the market goes down, those assets can be somewhat challenging to get your money out of, and so you may end up with the money being frozen. Now, on the flip side, you can look at the question and say, well, if I withdrew my money now before everyone else, is that okay? And the answer is yes, it'll work for you, because what's going to happen is the people left behind will be the ones stuck with well, I won't say frozen assets, but illiquid assets. And as a result, the property prices will be falling, and maybe the people left behind will bear the brunt of that. So one of the really strong features of the portfolios we put together is we will not have anything to do with an investment manager that won't tell us what they're doing with your money and where they're putting it. So all of our funds are independently researched at least twice a year, and often 4 times a year. The managers are very transparent about what they're doing with your money. We have complete confidence in your ability to access any of the money you have with us. Although most retirees aren't doing that, they're actually being quite prudent and not withdrawing as much money from their portfolio during this difficult time. So Cherie, the effect it may have is that it in fact may freeze some funds. I don't think it's going to freeze any of the funds that we have for our clients. If you've got family or friends that are thinking of accessing their money, to be honest, I would rather go now than later, because it may be that if the economy does slow down the way it's predicted to, there's going to be a bit of a rush on the funds, and it will be to your kids' advantage. And that's generally what I'm thinking that we're talking about. It'll be to your kids' advantage to access that money earlier rather than later. That said, the government won't allow people to go broke. Everything will be okay. They're printing money to fix it. But I think we're going to see some interesting times when we look at some of these industry funds now. Now, unless anyone has any other questions, we might call it at that. Thank you very much for your company. I hope it's been interesting. As always, please please email us or call us afterwards. Most of the staff are working from home, but we're talking 10 times a day. We're taking phone calls. We're responding to emails. I'm very impressed by the fact that Ryan is continuing to wear a suit and tie. Whereas there's some question whether some of us are actually just sitting here in our pajamas with a nice shirt on. But Ryan is holding the fort up in terms of his sartorial excellence.
Yes.
If there's anything else we can do for you, please give us a ring. Otherwise, we'll be talking to you next week. Take care. Be safe. God bless.
Thanks, everyone.
Bye now.
Bye.